In this episode of On the Tape, I am joined by Michael Gayad, founder and host of the Lead Lag Report. You would be hard-pressed to find a person more passionate about the markets, and he is never shy about sharing his views on all asset classes. We discuss Michael's newest venture, the launch of the Free Markets ETF, which is designed and constructed to benefit from owning stocks exposed to deregulation. In addition to the Lead Lag Report, Michael has also launched Lead Lag Media this past January, which is an ad-supported model connecting asset managers and investment advisors. Michael has had me on Lead Lag Live a few times, and now I get to turn the tables on him and ask him a few questions. We discuss the yen and Japanese yields and why the reverse carry trade could be something to watch. We discuss why he believes that U.S. yields will continue to fall, but at the expense of U.S. equities. We hit the U.S. debt, the Fed, and how banks are poised to bail out the U.S. Treasury this time around by purchasing its bonds. We discuss crypto, gold, private credit, and a lot more, including Michael's fasting diet. So please enjoy this episode of On the Tape. Today, I am thrilled to have Michael Gayad, founder and host of the Lead Lag Report. Join me, Michael. Welcome to the pod.
Dude, I'm excited. Come on, it's the first time you're actually meeting in person.
I know in person. We just said that outside. I'm like, I only know the thin, buff Michael Gayad.
Now maybe a little bit more
people
buff.
People that know you before, I don't know, but we're going to talk about that, obviously. So you wear many hats in the investment world, from author to strategist, portfolio manager, media personality, health guru. But your main constant is your passion, which I think you and I both share. But you are truly passionate about everything that you do.
Yep.
Namely the markets, but everything that you do. We're going to talk about that. So where does that passion come from?
It's a good question. So I kind of grew up in the business in the sense that I saw my father in the business. So my father came to the United States from Egypt in the late 70s, was one of those stories where he was dirt poor, worked at a gasoline station, had to learn the culture, learn the language, deal with discrimination back then, which was much more impactful or kind of out there, I think, than is out there today. Got an MBA from NYU, ended up finding his way into IBM, and then worked at Merrill Lynch. At Merrill Lynch, he worked on Bob Farrell's team. So people like you will recognize the name. Sure. A lot of the newer generation may not, but if you look up Farrell's 10 Rules, sort of this legendary technician from Merrill Lynch. He wrote 2 books on markets, and I only mention this because I grew up via osmosis in markets, because every single time at the dinner table, he'd be there with my mother talking about stocks, right? He was extraordinarily passionate about markets. He had all of these old tomes, these things that you can't even find in libraries that were written in the 20s and the 30s and the 40s about technical analysis, about markets. So I kind of got the bug from him. He formed his own RIA in the 90s, launched a hedge fund in 2000, had some clients. Stanley Druckenmiller was a client of his in the hedge fund. Again, I grew up seeing all this. I was never forced into the business. It was not one of those things where it's like, I want you to be in the same career as me. But I ended up liking it. I ended up working in the New York Stock Exchange when I was 16, got the bug from that too. So a lot of sort of family history there.
Very similar to me. Obviously, my father was a finance professor, so I was exposed to early. He was more kind of on the straight and narrow path of mean reversion, Ibbotson model, all that stuff. But I was more out of the box, but that's where I started my passion as well. So we definitely shared that there. So
let me ask you this, actually, on the out of the box. So did you find that made your way of looking at markets, was sort of you rebelling a little bit against your father? Because for me, I think there's an element of that. He had a very different way of looking at markets than I do.
I'm a big behavioral finance person in the market. Yeah. So I like to think outside the box in that regard. Formulas are formulas, and prices will go where they're going to go over a long period of time. But I like to think in the extremes. And I'm a little bit of a gambler in the sense of risk reward. So I'm willing to think what may happen or may not happen and take gamble. My dad gambled, played blackjack. I learned that all from him. So he was a big risk taker outside of that world. But as a finance professor, he kind of taught on the straight and narrow. But you kind of get to see both sides. And you might have been even opposite of that. Maybe your dad was a little more out of the box and you started in and moved out. I don't know, but it's a great combination. So it's great to have. So you've had me on your show a few times. Look, you're already asking me questions.
It's his habits, man.
This is my turn now to ask you the questions. So let's start with your most recent venture, which is kind of culmination of a lot of stuff you've been doing, which is the launch of your free market ETF. Talk about that, how it kind of originated. Obviously, we know what the theme is. We can figure that out from the title, but talk about that and how you
so look, I mean, I've been in the fund business for a while. So I have my mutual fund from 2012, 2 other ETFs. Those 3 funds are extremely tactical. The ATAC fund family, ATAC standing for atactical. With this fund, I had the idea in November when Trump got elected, obviously. And I said to myself, let me not think of this as a portfolio manager. Let me think of this like a product developer. Which, by the way, if you're in the fund launching business, is a totally different mindset than managing your own portfolio, right, on a discretionary basis. And I looked at this more like a VC type approach. Let me get some other partners. Let me spread out the risk. So I contacted 2 other RIAs who I'd known for a long time. Tidal, which is the advisor to the fund. I said, I have this idea for a fund that's focused on deregulation, right? This is obviously going to be a big push for Trump. Now, the question, of course, becomes, okay, sounds good, but how do you even identify what benefits from deregulation? And it's actually not terribly, terribly difficult. You look at the most regulated sectors, figure out which companies have already operated efficiently in those sectors, and then use some AI to look at executive orders, speeches, things like that to sort of see what, on a near-term basis, has the most potential. So it was roughly a 5-6 month process, right? From idea to signing the LOI to doing and building out the AI, making sure that we have everything figured out on the prospectus. Launched that FMKT Free Markets ETF June 10th. Now, there's a little bit of a backstory here. So I mentioned I launched my mutual fund in 2012. Risk on, risk off. I launched the day of QE3, right? And that matters because if you're risk on, risk off, you need periods of risk off. And here comes one of the smoothest bull markets, pretty much since the 90s, since I launched that mutual fund. Mutual fund, never really sort of had any sort of outsized performance. 2020, COVID crash happens. The mutual fund is up 72%. I went from 60 million in AUM to 384 million by February 2021. No wholesalers, just me, sheer grit, force, talking to people, raising AUM, and people chase performance. We know how this works. Then I launched 2 other ETFs, Roro and Jojo, also highly tactical. All 3 funds have different signals, but they share the same commonality of risk off, which is long duration treasuries. Now, I'm saying all this for a reason. I thought in 2020, 2021 with the mutual fund, and the launch of those other ETFs that I finally got my escape velocity from a career perspective. It's like, all right, this is my moment. I got the convexity. The fund was designed for tail events. Tail event took place. Let me diversify the fund family with the error being made that all 3 funds relied on long duration treasuries as the risk off option in the worst bear market for treasuries in history. And I've taken a lot of flack for that, right? Because people are like, oh, your funds haven't done well. You've lost your AUM. You're not doing what. So there was a part of me in wanting to launch FMKT that was nervous about how it would be received. Because to the outside world, not knowing how the fund business works, not knowing how a prospectus works, these people would look at my 3 existing tactical funds and say, oh, here comes another fund by Gaia that's not going to work. This has been my mindset up until launch, right? I've been very public about being sort of battered and bruised from a mental perspective because of this nasty cycle that really just caused me to go round trip, right, in the fund world. And lo and behold, totally different strategy, totally different approach in my tactical funds. Day 1, we had 403,000 shares traded out of nowhere. I had fund issuers contacting me saying, where'd that come from? Who's your anchor investor? Nobody. I think this is one of those things where I may have finally, hopefully, timed the cycle just right. And that's an important point. I think when you're a fund manager, a product developer, you are trying to create a product for a cycle, and you're hoping the cycle hits the moment you hit that on that product. That was the exact opposite of what happened with my other funds, right? Launched on the day of QE3, wrong cycle. Launched Roro and Jojo into the worst bear market for treasuries in history, wrong cycle. Here comes deregulation. This is just starting.
You talk to a lot of different people, money managers, CEOs. You have people on your show. You can learn a lot from them, I'm sure. Sure. And yeah, there's bad luck, bad timing, but you've persevered. And now I would say that this is kind of culmination of all the stuff that you've learned kind of along the way. And I wouldn't blame yourself. And that was a massive standard deviation event, obviously treasuries, and who could have seen that type of inflation coming? We'll talk about Powell later. Certainly he didn't think we were going to have that type of inflation. It was going to be somewhat transitory, but it wasn't. So this free market ETF. So my question is this. So we kind of knew going into the election which sectors would benefit. Sure. So now we're 7-8 months later into that cycle, right? And so some of it priced in, some of it, it was kind of buy the election, sell the inauguration is what we saw, a lot of stuff. And now it's all starting to happen now. So when you constructed this portfolio, and I would tell people to go look at it, it's really interesting. It's got banks, it's got uranium, it's got all kinds of stuff in there, and it changes and evolves. Right. And you've mentioned that you're using AI to kind of read whether it's the big beautiful bill, whether whatever it might be. And so explain that to me, because some people would say, well, this is a laggard into the news that's kind of already out there. But tell me what you think it differentiates itself in terms of being able to stay up in real time of what's priced into these stocks and what's not.
So I view deregulation as a condition, right? Not a call on things. It's a condition. It's a condition under which companies can thrive, be more efficient, generate more revenue, increase their profit margins. The market may price in all available news in the long run. I don't believe it does so in the short term. I believe in market efficiency very long term. I don't believe in it short term. And I think there's a lot of academic, you talk about the finance professor, behavioral finance. Yep. Behavioral finance is why the inefficiency does exist. Now, you're right. Everybody sort of has a rough sense following Trump's election of these sectors will likely be benefiting the most from his policies. But a lot of these executive orders are coming out on a Friday, and they hit on things that seemingly come out of nowhere. There's one very recently talking about coal. Okay, so coal now is something that's, coal stocks are being actively considered for the portfolio. And a lot of those coal stocks have been beaten down. Okay, well, if that's a condition that causes them to, from a fundamental perspective, generate more revenue, it doesn't matter if the market's priced in something in the very short term. There's a huge trend there, right, to play at least for the next 3-4 years. The mix in the portfolio is definitely unique. And I think in a world where every single fund is basically a closet Mag 7, because that's what's worked, right? For this fund, and it has, fortunately, as we're chatting, has outperformed solidly since inception. It's only been roughly 6 weeks, but still. I think it's a testament to the idea that deregulation can be a big driver for stock pickers if you are identifying which companies benefit from various executive orders as they come out.
I agree, and I think one area is nuclear, which is the only thing I can think of that's bipartisan support on at this point. So
it's
I know
green
that,
energy.
I know,
that's right.
Exactly.
ESG, there you go.
So one of the other things you started doing, and I guess earlier this year, was lead lag media, which is where you launched, I guess it's an ad-supported model, though, but you're connecting asset managers and RIAs, right, advisors. Talk about that, too, because that's also an evolution of all the discussions and people that you know in the space.
So in the fund world, there's only two business models. You either hire a whole bunch of wholesalers, they're doing the wining and dining, the steak dinners and the golf outings and all this. Or business model 2 is you view yourself as a publisher of content and you hope you monetize your content through strategies funds, right? Now, I've always taken that approach with my own funds, my own fund management career, right? Build my name up, be known. If I get a couple good calls right, there's a halo effect. People say, oh, Guy also runs a couple funds. I'm going to look into those funds. So for the last decade plus, I've done anything and everything you can imagine when it comes to how to raise assets for my mutual fund and then my ETFs. Now, I said to myself, all right, well, I do this for myself. Why couldn't I apply this as a model to other fund issuers? Because I see they all have the same issues.
Sure.
Everybody has the same problem. How do you raise assets in a very saturated world where you're competing against Vanguard and BlackRock, right? So created basically an agency the last 8-9 months, which thankfully has exploded in growth. I've got 27 fund issuers that are engaged with me and my team. Also now working with financial advisors to give them services. In the beginning, it was much more about me as the influencer. Now it's a full legit business. And I view that lead lag media, which is a separate entity from my RIA managing the funds, as providing services also to my own funds. So my funds are basically a client to that business. The reality in this business is that nothing closes a sale like a chart, right? If you're a fund company, nothing closes a sale like a chart. So the one thing that nobody can control performance is the thing that gets you the most assets. But you don't know when the performance is going to hit. So you have to do things to plant the seeds for whenever that performance hits. And that's what a lot of me and my team are focused on with that lead lag media business entity.
Yeah, it's really interesting. And plus, you get to learn about current themes. You can see what's hot, what people are raising money, what RIAs are doing, new products that come on. And we're going to get into some of those products, which are now going to hit RIAs, private credit, which I know you're going to have an opinion on and so forth. So, all right, let's get into the markets here. You're a serial Xer, tweet, or whatever it's called at this point. And one thing that you and I have always matched up on was kind of what goes on in Japan can have an impact on these markets. And the carry trade and what you're calling kind of the reverse carry trade, so to speak. And we've had fits and starts with this the last few years, and nothing has really happened in terms of a massive, eruption of volatility that has spread. So give me your current thoughts, Eric, because that seems to be the one thing that you keep harping on, want people to watch.
So it goes back to the idea of framing it from the standpoint of a condition. I always use that analogy. I don't know what mile marker I might crash my car. I know the conditions that favor the accident, right? Okay. So, and it's not that I'm a perma bear by any means. What I like to tell people is that it's not that I'm bearish on stocks, it's that I'm bullish on a tail event.
I guess that makes me bullish too.
Yeah, exactly right.
Okay,
That's always, right? I'm not saying stocks go down and stay down, right? But obviously, it's like you'd remember this better than I would, but with 2008, with the Lehman crash, it's like that 2-3 week period basically defined 8 years of performance. I mean, you don't have to get
it all led up to that moment. It was
exactly right. But it's like it was a very short window that just erased all this time. And I actually view crashes much more in terms of how much time you give back rather than percentage. That's a whole different sort of angle. So I've been on this reverse carry trade theme really since August of 2023. So it's been 2 years. And for
people out there, carry trade is the cheap yen. You take that, you lever it up, and you go buy U.S. assets with it. So just wanted to be clear.
Exactly right. So it's exactly right. So you get basically at near zero rates. You borrow that money from Japan, you deploy it in other risky assets, treasuries, things like that, and Nvidia, which might explain some of the move also.
Right.
Now, it was very clear to me at the end of 2023 that Japan was facing the potential an existential cycle shift. Okay, because they were talk about lags. You talk about 2 decades of basically incredibly easy monetary policy, deflation, then
negative rates,
right? Yeah. And then suddenly now real inflationary pressure. So the thesis was very simple. There's going to be significant inflation. It's going to cause a disruption in their bond market, and they'll have to. The Bank of Japan at some point will, in quotes, panic, right? Which I keep on saying repeatedly on X, with the Doctor Strange one finger, one scenario, right? By the way, just to be clear, also what I do on X is an act. And it's an act because it works. Like, you have to play the engagement game. I see people saying you're just an engagement farmer, being loud and doing things in caps and being sarcastic. It's like, yeah, but I'm a business owner. I'm trying to get attention. What else can I do? If I come across like a professional CFA charter holder, which I actually am.
Let me ask you a question on that, because you do it somewhat, to create, people engagement, but you also get upset when people engage with you on that. So you can't kind of have it both ways. So you're putting out. So, and I know you've battled with that in a good way. I mean, you're just passionate. I love the passion, right? But I try to not take stuff personally. I mute people. I just don't want to deal, but I need it because it's a great information source. So tell me, where do you draw the line between? And you're getting better at it, I assume.
No. So actually, this is relates a little bit to the personal journey. So going back to my mutual fund, got to 380 million. I thought I hit escape velocity. This is my moment. And then I'm not stupid. I could see what was happening with treasuries at the time, and I can't do anything about it because I am managing to mandate. So of course, all these knuckleheads on X start saying, "Oh, your funds are terrible. Look at what's going on." And it's I have no choice. I have to manage by the prospectus of the funds, and the funds are rules based. So I can't even do anything even if I wanted to.
Right.
Okay. They call it comfort food for a reason, right?
Yeah.
So obviously, I think with hindsight, and I'm very public about this. And I think people should be more public about this. I think it was probably from 2021 up until about a year and a half ago, I was probably going through some form of high-functioning depression. High-functioning depression is a very specific form of depression because nobody knows that you're depressed. You're still able to do a lot of things and work at a very high level. But I just went through a cataclysmic round trip in my career. I really thought I had made it after the 2020 period, and I was trying to diversify the fund family, and then it's all getting ripped away from me from this cycle. And all these people who don't understand what I'm going through are then piling on and attacking. I don't even know if they're people. I mean, we know there's a lot of bots, programmatic hate, right? So, yeah, no question I would respond. And my personality is to be a fighter. So if I see somebody saying something stupid or from a place of unintelligence, my response is to go back and get at it. That's my defense mechanism. But I think it's also partially related to the high-functioning depression. As I have gotten healthier and done this journey as far as the fasting, the weight loss, the muscle gain in my late 40s or early 40s, soon to be late 40s, I to your point, I think I've improved on that. I think as everybody knows as they get older, it's like time is the most precious commodity, and people waste so much time saying very stupid, nonsensical things on X and on social media in general. It's like, why even bother responding at this point? You're wasting your time. They're wasting their time. It doesn't help anything.
No, it's very inspirational. So the mind-body connection and, the things you can control and feel good about yourself. Exactly. So listen, that time period, the market's a very emotional place, right?
Of course it is.
And you're judged in real time by the things that you say, oh, you must be wrong because it didn't happen on day one or day two.
Right.
In dealing with the mentality, a lot of people that are out there, even since COVID, with a lot of retail investors which have joined the investment community, which I think is great and healthy, not understanding that aspect. And also only knowing that the Fed has your back and only knowing that QE1, QE2, QE3, QE4, and what I believe will eventually be QE5 to come, that, you know what, they're going to clean it up for us. We're going to make a mistake, so let's go out on the risk curve. Those are all hard things, certainly from our backgrounds and our dads as well. Understanding, reversion to the mean and things like that to kind of instill. And sometimes people, it's a no-win situation. I've learned on that, but, congratulations on your journey. I've only met you in person once today. We've been on the phone many times before. You look great to me. So,
I got that. I will not relent shirt.
You will not relent. I'm going to have to get one of those. You're going to have to teach me a little bit of the. You're going to have to give me some of the fasting things that you do. By the way, can you talk about the fasting stuff? Because you're doing it once every 30 days or 60 days? What are you doing?
Yeah, it depends. So I usually I'll do OMAD, 1 meal a day, and then I do several of these extended fasts, 3, 4, 5 days. I've gone as long as 7 days without eating, which people think is crazy, but actually is one
Talk
of the
about
greatest.
mood swings. I would want to. I mean,
No, you actually. I tell you, I feel my best unequivocally around like 40 hours of no eating. You feel oddly enough super energized at the gym. I'm always the one that goes the hardest when I'm that deep into the fast, and people think it's bizarre that I'm able to have that kind of energy level without food.
Right.
But if you just take a step back and think about it from an ancestral perspective, we were never designed to eat 3 times a day. We were always designed to have volatile eating windows because it was about when you could hunt, right? And if you didn't eat for a while, your body's telling you better hunt. So what happens? You get focused because you got to hunt.
Yep.
So you get this really interesting mental high also when you don't eat for some time. So it's not like there's a difference between fasting like that than anorexia and having like a legit issue. Like for me, I'm doing it purposely and very regimented. So yeah, it's been and then when I eat obviously super high protein. But going back to the reverse carry trade real quick, I think it's going back to its condition and to your point. It didn't happen on the person who hears the thesis' time frame and they think it will never happen because of that. And it's a ridiculous argument. There were people from, this because you lived it, 05, 06, that were saying the housing bust was going to create a crisis. They were wrong for 2.5, 3 years until suddenly they were not just right, but that being right defined a decade of performance. The reverse carry trade or the carry trade dynamic is a very significant one to keep in mind because Japan is going through something it's never seen before with extraordinary leverage, extraordinary debt. At some point, the Bank of Japan panics. That means they have to save the yen. If they're going to save the yen, which means they have to prop up the yen, they're going to sell treasuries for a moment in time to raise dollars to buy up the yen. That happens, then suddenly all of the borrowed money in yen from those near record low rates starts going back into Japan because now they're getting hurt from the currency conversion. And if you have that all at once, that's what creates a dislocation. We saw shades of that August 3rd, August 5th. I remember on August 5th when actually I said, I bet you now it's a low. Because everyone was high-fiving me saying, you called the reverse carry trade. I didn't know it was going to happen those 2 days, those two trading days. Condition, not mile marker. I had 14.5 million impressions in a single day organically on X because I've been so adamant about this thesis. Everyone freaked out about it, and everyone forgot about it 2 weeks later. Right? It's like this entire market has the attention span of a flea. That's not to say that it can't happen again, though. Just because people have ignored it and are saying it doesn't matter because look what happened August 3rd, August 5th. One of the necessary conditions for a crash is people think you can't crash because of that catalyst. It's no different than when you're driving. It's like, well, if it's raining and you keep driving and you didn't crash, well, I guess that means you should always speed up. Of course not. But in markets, nobody thinks that way.
Well, it was a year prior to that Bank of Japan finally changed their negative yield.
Right.
And based on the range of the 10-year up to 50 basis points. Then we'll let it go to 1. We sit here, it's 1.5, right? So it's been happening now for a while. And now you had elections, which are basically could force the hand even further. So you bring up that point, but right now you're also calling for lower US Treasury yields. And so that's kind of counterintuitive. And I think one of the things you think could spark that would be a sell-off in US equities, which would then plow money in US Treasury. So how do you weigh the reverse carry trade with what you believe will be, is that a short-term call on US yields?
So I always go back to path matters more than prediction. So the original thesis was what will really force Japan is rising oil prices. Because they import all of the oil prices. So if oil priced in yen, if the yen keeps tweaking against rising oil, it means now it's even more cost-push inflationary pressure. Okay, so then they have to make a choice to save the yen, push the yen higher, because they can't control the price of oil. They can control the price of yen, so that's how you can resolve that. Okay, so the initial thesis was they'd sell treasuries to raise dollars to buy yen. But that creates some volatility in equities. But then as the volatility in equities continues to pick up, then money would flee right back into treasuries. So you have the sort of initial yield spike and then a yield collapse, right? Now, it's not my opinion. It is fact, no matter what anybody says. Historically, you look at the CRISP data set, Center for Research on Security Prices. You look at going back to 1961, the top 1% of S&P 500 declines or market declines on any single day. Biggest declines in history, yields collapse. Unequivocally true. That's the flight to safety. What's the safety? Safety is treasuries because at least you know with treasuries you will get your money back. Whereas if the S&P is collapsing, that also means credit spreads are likely widening. Default risk in corporate credit is rising. And those that are lending capital say, I don't want to take the risk of not getting my money back, so let's go to the money printer, right? So I keep on using that line, they'll crash stocks to save bonds, and people are like, who's the they? The they is the invisible hand, right? But it's just a mechanical truism that in tail events, yields drop. Now, the important part about this, which is missed, is historically, you get those really big declines in stocks. Treasury yields drop on those days. Stocks rebound on that capitulation. Yields, though, tend to continue to drift lower. And this is what's missed by a lot of people who are not really following the analysis. The idea of they crash stocks to save bonds is actually, it creates a cycle shift in treasuries. Stocks could rebound off of that low, but yields are much more likely historically to keep drifting lower, right, on that shock.
All right, let me counter that for a minute. I want to get your
Please,
thoughts.
yeah.
So if we have debt that's going to go to 41 trillion, we just raised the debt ceiling to 40.
Yeah, why not?
So it'll go there in the next 2 years. Okay, deficit off the charts, debt to GDP off the charts. We're not Japan, but we're where Japan was, 20 years ago, in terms of those ratios. So with that, with the wealth effect in the stock market, which I believe is massive, I think that the stock
100%.
market, right. So let's go with your thesis, and then I want humor me on this next one. Stock market sells off. Definite hit to GDP, in my opinion, okay? Tax receipts and so forth.
Right.
Debt levels, unsustainable in the U.S.
Yep.
What happens if the belief is that the U.S., which I know we can print into infinity, which we're going to end up doing, can't pay their debt, and or it's going to require a higher term premium or higher yield to do it?
Right.
How do you incorporate that? Because every other cycle, I totally agree with you. Flight to safety.
Yeah.
What's safe? How is that safe? So how do you kind of philosophically incorporate that to your mindset?
So you would still lose, but likely lose a lot less than everything else around it.
Yeah.
Right, which I think is still a win.
Sure.
Right? I mean, look, when you look at the top 20 drawdowns for the S&P 500, again, going back to 1961, I think it was, as I recall, 10 out of the 20 treasuries made money, meaning yields dropped in those big drawdowns for equities. 8 out of the 20 treasuries lost money, but they lost a lot less than equities, so you still had a decline and lost money. Right? 2022 is the only year in history in top 20 drawdown where treasuries lost more money than stocks. So I think it's a relative argument. Relative can still be okay. Now, I use this line repeatedly also. The end of the world is the bull case. Okay. Under that scenario that you just outlined, the implications are reserve currency status is finished. Okay. Well, then everything then goes away.
You're right. How do you trade the end of the world? There's no point.
You can't.
No,
Right? So
I'm with you.
Yeah. So that's my issue with sort of,
No,
especially when your starting point is so much leverage.
It's a good point.
Right.
I'm just saying, but you can have that period of time, and then you would have some type of retrenchment. So let's talk about the banks. And I just saw an interview with you on TV where it's the banks' turns to bail out Treasury after Treasury bailed out the banks in 2008, right? SLR getting relaxed, supplementary leverage ratio obviously allows the banks to hold more treasuries with less capital, could create demand. Stable coins now, another way to kind of, pick up the supply and T-bills. Talk about the bank's role there, and then the banks in general, and then I also want to get into private credit because I think that's an important asset class.
And I'd argue it's also all connected. I mean, even Besson himself said that one of the reasons private credit has exploded is because the regional and community banks have been so handcuffed. So capital is going to other places, and private credit, which Fed doesn't like and Treasury doesn't like because you can't, it's opaque, right, from that standpoint. The supplementary leverage ratio has, I think, in general, made banks more like utilities, which you can argue was partially sort of the natural reaction post-GFC.
Probably a good thing for a period of time.
For a period, but you exactly said correct. It's like for a period of time, right? As things sort of get resolved from just the risks that were there pre-GFC. So a lot of these banks have been unable to go out there and very aggressively lend. Now, with that supplementary leverage ratio, that basically has prevented them from buying a certain number of treasuries also because they have to hold capital against treasuries, right? So normally that's considered the, in quotes, safe collateral. But if you have to hold capital against the safe collateral, then it's not really safe collateral. That's the way the legal aspect of it, or you can argue the
and it certainly was not safe in March,
right?
But 2023.
Exactly right. Which, so you can argue from that standpoint was totally valid,
Yeah.
and you even saw that with the regional bank crisis from which I would argue was QE4.
Yep.
Right. It was stealth liquidity unequivocally. So so now there's an interesting other aspect to this, which is that limiting factor. Okay, on how much these banks can go out there and lend with, I'd argue has been one of the reasons that small caps have performed so poorly since 2011. Okay, it was the SLR I think came in 2014 with the threshold that we have today. Why does that matter? Because regional banks, community banks, that impact small businesses. Small caps are the small business of the U.S. stock market, and they've underperformed very badly against large caps really since 2011, 2012. So I'd argue that. If Besson is serious about deregulation in the financial sector and the supplementary leverage ratio is a part of that, if you allow the banks to go out there and lend more, that will benefit small caps, that will benefit small businesses, that will benefit and cause a whole nother wave of liquidity. Now, on the one hand, you'd think that that's actually inflationary. I'd argue that's actually disinflationary, because what's inflationary is pricing power. If you have more small businesses being out there and getting access to capital than they did before and competing, now you've got lower price potential dynamics, right, in the long term. So it can be a very, very positive dynamic, and if they do that, that does mean that likely there's going to be an increased bid for treasuries by the banks, which will also lower yields.
Private credit, though, has filled that void a little bit for the lending. So that's not monitored by the regulators.
Right.
We know the size. I mean, it's in the trillions and growing. Covenant light loans. Loans are being modified, mark to model, not mark to market. We understand this game, but no one's really that concerned because it can't bring down the system. It's off the bank's balance sheets to a degree.
I got to tell you real quick, though, I've used that line before, and I believe this. I do believe that private credit is this cycle's equivalent to subprime.
Yes.
Right? Because, okay, so it may not be systemic risk, but to your point, when something's not marked to market, the implication is, well, it's marked to model, so it must be performing well. So what do you want to do? You want to leverage that even more. And the precursor for every single crash in history is always leverage. So if you have something that's not marked to market, there's an incentive to want to lever it up more because, hey, look at the returns, which are make-believe, but I believe it.
Yep.
Right? And that's where I think private credit could be a problem. I don't think it's an 08 type problem, but I think there's a deleveraging event coming from that.
No, it's the banks are providing the lines of credit that they're going out and lending.
Right.
Same way they provided the warehouse lines to the mortgage companies to go out and lend so they could put them in their CDOs. I totally agree with that.
Right.
All right. So that goes to my next question, which is all of a sudden, retail investors, guess what you get access to? Private credit.
Yeah.
Right. So they're going to come in all forms, high fee product. Yep. Great because it doesn't get marked, so you can think you're getting access. Right. What are your thoughts on that? I mean, you talk to retail investors. There's some of your clients that are out there, right? What would be your recommendation? Stay away, run and hide because last game in town, or you think you could be selective?
You can probably be selective. I'm sure there's always going to be selective opportunities, but I mean, can you imagine a situation where certain private issuances now become like the new meme stocks? Yeah. I mean, that seems very bizarre to me, right? Candidly, I don't know if retail will go into it as aggressively as people think retail will. And I say that because I think if you look at most people's phones, they have two apps you can almost guarantee that they have, Robinhood and DraftKings.
Yeah.
It's hard to gamble with private credit, or at least it's not as interesting for retail to gamble with private credit when they can do so with 2x, 3x levered funds, right, and extraordinarily high yield, risky individual investments and companies that are just going vertical. I just don't think the excitement is going to be there to sort of create a huge allocation.
No, I totally agree. I'm really talking about kind of the higher end individual, maybe the quote more
accredited,
right.
Sure,
so
right,
that have the broker at Morgan Stanley that says, oh, you can do hedge fund, or you can do this private credit vehicle. It shows a yield of X. I'm saying normally when you get an opportunity like that, it's not a great opportunity in general. But you're right. As far as in and out and immediate gratification in the market, it probably doesn't fit. However, there will be things tied to it. There will be
100%,
companies that are public that are issuing something related to that, in that regard. All right. So I skipped over this a bit, and I want to go back because it has to do with market volatility calamity, which is Bitcoin and gold. Your thoughts for both of those assets in people's portfolio?
So we actually have both in the free markets ETF as we're recording this, because those are good examples of free markets. There's, they have a lot of interesting characteristics from that standpoint. Now, I am by no means a Bitcoin maxi. I think a lot of these narratives are outright stupid. It's not a hedge to inflation. This is fact. It's not a store of value. Neither is gold, by the way, because the definition of store of value means predictable. You can't have something that's predictable when it has in the distribution tail risk, right or left. Like statistically, it doesn't make sense to argue that's a store of value from that standpoint. But it's an asset, right? And it's like, what's it worth? It's worth whatever people are willing to pay for it. It's like everything else. So I think it makes sense to have a portion of your portfolio in both Bitcoin and gold regardless. I don't know when Bitcoin will suddenly converge into being a risk-off asset. I think for Bitcoin to act as an inverse play to equities, the risk needs to be some kind of credit dislocation. Because the one thing I do agree on that gold and Bitcoin have in common is that while they're not an inflation hedge or a store value, they are a counterparty hedge. Gold you can hold. Bitcoin, you got the distributed ledger. So from that standpoint, it's when there's these inevitable periods where banks and counterparties don't trust each other, those two I believe you can trust. But in order for both to act risk off to counter equities, that needs to be the source of the risk.
Okay. And let's talk about Powell and the Fed here, because it's going to be front and center. There's a meeting next week. By the way, Bank of Japan also has a meeting next week. What do you think about Powell? I'm just curious. And what do you think would happen if he was fired or let go prior? I mean, he only has 7 meetings left anyway at this point. We're not, every month that goes by in meeting, it becomes less and less important, I guess, to the markets. But we've seen fits and starts when the threats get thrown out there. What we've seen, yields move higher, equities move lower. What are your thoughts on how he's done? Obviously, I can tell by how we started this conversation that you don't appreciate what happened in 22 in terms of not controlling rates. But talk to me a little bit about that.
Well, I mean, I think, look, it's always easy with hindsight to say they should have done this or that, in fairness. And yes, they have access to all of this data information. I think, taking a step back, I think when it comes to the Fed, the question is about whether they are being political or not, right? And I'm not a conspiracy theorist by any means, but you look at where most of the Fed employees and governors and all this, where they tend to donate to Democrats. It's something that Andrew and Ross Stoker's talked about with others, right? So I only mention that because if it's political and it's not just purely based on data, then they will always have an incentive if it's political to keep rates lower. Which, by the way, is exactly what Trump himself is alluding to, right? We need lower rates. Anything at the moment. I remember there was this great interview that Greenspan had done many, many years ago. He was doing the book tour for The Age of Turbulence, and he had said something along the lines of, never in his time as Fed chair did he ever have a congressman say hike rates.
Of course,
right? So I think you can fault Powell and the Fed for keeping rates low because I think they are political and they did unfortunately want to keep that liquidity easy. I think it was beyond the vaccine reopening. They missed it entirely because there was an incentive to keep rates lower. Now, I don't think they or anybody thought we'd have this kind of interest rate cycle. Some will argue that, they saw it coming. Of course, the rates are going to 5%. I don't believe that. I think the vast majority of individuals thought it hit 2.5%, 3%, and that was it. We way overshot that, right? I wouldn't say that he failed. I think that he had his blinders on. I think he did have political pressure to keep rates low. I think he probably should have hiked rates more aggressively. And candidly, when the regional bank crisis took place, he probably should have let it flush out, right? They were worried about another 08 repeat. But one thing you can argue is a way to break inflation is a crisis, right? They should have let that play out instead of stepped in for the weekend and did a stick save, right, all over again in 2023. Because I think if you did that, you would have squashed a lot of the inflationary pressure almost out of the gate. I don't know if anybody else would be any better, though.
Let's start with the 2023 crisis and work our way backwards on that. First of all, this is not about politics at all, but Powell was appointed by Trump. I don't think anyone thought that, between the stimulus checks and all the other stuff that went on, that you could have those supply chain impacts from COVID.
Right.
No one could predict. So I think it fed on itself, and I think everyone was surprised by the amount of inflation that came in, and they were late to react. I don't think it was political, but I'm not picking sides here at all. But in 2023, think about this irony. What got bailed out? Silicon Valley Bank.
Yep.
Silicon Valley Bank was the center of venture capital. It's everything that ended up getting Trump elected. Right? Reelected. J.D. Vance is there because of all those people in Silicon Valley. What do? They turn on Powell, right? Obviously, meanwhile, he's the one that saved them back in the day. So I just think, to your point, we've been in unprecedented events that have occurred. I don't know how anyone would react. And I'll tell you this: I didn't like Powell, and this had nothing to do with politics. Early on, when he stopped raising rates, we've had fits and starts back in 2018, 19, and things like that. It's just difficult if you're in that seat and you see how much debt there is, right, on the balance sheet. How many treasuries and mortgage-backed securities that they're holding that they had to unload, right, taper, Q. We're still sitting at $6.7 trillion. We still haven't paid. So I don't know. I think there's a lot goes into it, but I think it comes down to the fact that, forget who was in the White House, you ruining my soft landing with these tariffs. You ruined it, right? So now I got to go out of my way. You're right, maybe a little bit bullheaded to protect what I've done. And I think he did a magical job, pre-tariff, I'm talking about all this other stuff, in creating this soft landing scenario and talking to the market. So I give Powell credit for that. And I agree, maybe he's being over cautious in terms of what impact tariffs are going to have an impact.
For sure.
You can't have, if you're counting $100 billion coming in to the kitty, somebody's paying for that. This is not like a just game. So, but anyway, I was just curious to get your thoughts. So I think he'll maybe end up riding out his term, but who knows? A meeting next week and all of a sudden, he doesn't allude to cutting rates in September, and then who knows? But
so the week of the low in April, when you had that Monday where it was Trump is going to announce a pause on tariffs, the market surged, Nasdaq surged like 10% within minutes, and then the White House walked it back. they denied that they ever said that. Of course they said it. They were testing the market's reaction, right? And then you saw that Wednesday on the low, when the Dow was down 1,500 points, they announced that, and you had this. That was the turnaround moment. I think it was, wasn't it last week, where there was something similar, where it was reported that Trump is actively discussing firing Powell.
Yeah.
And the market reaction sold off, and then he walked it back.
Yeah.
So as much as people may think Trump is naive, I don't think he's stupid. I think he does things and tests the market's reaction. So he puts a rumor out there, floats the blue, and sees what the market reaction is. Okay, well, what if I did fire Powell? What would happen, right? So it's the same dynamic. I think they are testing it. But I don't see the point. Like, why cause a disruption? Just let the term go, and that's it.
All right, so let's close with this. We're kind of back in these meme stock periods again, right? Whether it's crypto meme coin or whether it's open door or whatever it might be.
Yep.
And like me, you care about the retail investor. You actually try to help them and protect them. I really believe that. We do. It's not like you're trying to make a quick buck, pushing a stock, selling, and so forth. What are your thoughts here? Because it feels like we're back in this kind of euphoric stage. The bull bear index is really high. We're due for some type of pullback, but it's happening again, man. Like these meme stock stuff. It's happening.
Yeah, meme stocks, the flows into levered funds. I mean, the speculative behavior is absurd. I saw something around call option activity again, like hitting another high. We've become a gambling society. You can argue we always have been, but now it's like
the access is
now
tremendous.
the access is unbelievable. Right, sure. Exactly. So and gambling is an addiction. Leverage is an addiction, and when you lose your money, what do? You sell your watch. You find other ways of trying to relever, right? So I do worry about that. And again, I go back to that is one of the precursors to a crash, right? So, which goes back to being bullish on a tail event. Look, I think it's great that retail has come into the market, and I think there should be as much democratization as possible.
I agree.
But I do believe also that studies are valid in the idea that over trading and excessive risk-seeking behavior ultimately is the road to ruin, right? And that's why we're about the retail mania, right? Because like people's lives will get destroyed at some point from this, and we shouldn't want to see that. We shouldn't want to hope for that, obviously. But it is something that we have to just be mindful of. And I think when you talk about educating the retail audience, the thing you should be educated on is risk of ruin, not just how much you can make on some kind of out of the money call option that you traded intraday.
Well, Michael, listen, you're an educator, an entertainer. You're passionate about everything that you do, and no one can ever take that from you. It's been incredible just having met you basically 5 years ago or something, 4 or 5 years ago, how things have evolved. Feels like you're in a great place, physically, certainly. Mentally, it sounds like. And this free market ETF, I wish you all the success in the world. And people can go out and find you. So how can they find the Lead Lag Report on Substack and tell people how they can find everything?
leadlagreport.substack.com. We also have the free markets report, freemarketsreport.substack.com, at Lead Lag Report on all the social media platforms, X, Instagram, LinkedIn, YouTube. And listen, I do believe deregulation is a massive theme. FMKT, I think, is a great way to play. It's the only ETF out there designed to play that. I do also think, just as a way to wrap this up, deregulation has implications on broader market volatility going forward. If you think through, I keep using this analogy, if you look at the most regulated sector of the stock market, what is it? It's utilities. The least volatile sector of the stock market is utilities. Regulation causes volatility suppression. Deregulation should unleash more volatility, which means maybe more risk on, risk off, which actually, if you're tactical, and which is where my other three funds come into play, ATAX, Roro, and JoJo, my hope is that the environment then also favors more of these vol pulses, more frequency of vol, because deregulation, freer markets should result in that.
And I would be remiss if I didn't make this public service announcement that with everything that you just said, SEC less enforcement, no CFPB. People need to be very careful because no one's going to come save you if someone fools you and you buy something yourself. So again, you're there to help people. I feel like I'm there to kind of help people get through that. And so, Michael, thanks for coming on the tape, and hope to have you back on the show.
Yeah, man. No, I appreciate you.